I'm going to be talking about Islamic finance risk, Islamic banking risk. The important thing to remember and realize is that Islamic banking is not something completely different from conventional finance. Islamic banking, Islamic finance is simply a subset, a small subset of conventional finance, because everything within Islamic finance is permissible in conventional finance. Murabaha is permitted in conventional finance. It looks slightly different. It looks like a sale and repurchase agreement. Looks like trade finance. Looks like commercial paper. Sukuks are permissible in conventional finance, but they're called leasing. We've got Mudaraba, which is simply investment schemes. We have Musharaka, which are very similar to equity investment schemes. We've got to remember that everything in Islamic finance is permissible in conventional finance. So we have leasing, which is in general finance, and with certain restrictions, it's ijara in Islamic finance. We have bonds in conventional finance, and under specific regulations, you could call them sukuk, specific types of bonds permissible in Islamic finance. And we have sale and repurchase agreements in general finance. We have commercial paper, we have bills, but under certain restrictions, we have murabaha in Islamic finance. So basically, the risks under Islamic finance are simply a subset of the risks in conventional finance. So focusing purely on the Islamic aspects of Islamic finance, well, one major aspect is the religious risk. So the risk that if you enter into a Islamic finance product, be it murabaha, commodity murabaha perhaps, or if it is a sukuk, the religious risk, what's that? It's the risk where you enter into these contracts in good faith, and then 6 months or a year down the road, the market has a good look at these structures. They may not be as clear as they first seem, and the market decides, the Sharia scholars through the market decide that they're not really rigorously Islamic. And so the market dies on these products. You cannot issue or reissue these products, and also you cannot sell them because the market deems them no longer to be Sharia compliant. That's one major risk, and that needs to be addressed very carefully. And then also you have the risk of uncertainty. You have to be really, really clear as to what the products, what the underlying meaning, underlying structure of these products is. If later on the contract is deemed to be slightly different from what you were saying, well, it's not so different from mis-selling. So even there, you have a conventional parallel. So it's very similar to the concept of mis-selling, except in conventional markets, the concept of mis-selling generally specifically applies to retail rather than wholesale, whereas in Islamic finance it applies all the way across from retail to wholesale. Beyond in Islamic finance, well, there is an issue of focus, of concentration of business types. In conventional markets, you can apply your investment portfolio to everything, and by pure definition, if you remove certain aspects, for example, highly geared investments, then tobacco, alcohol, then you are investing in a narrow pool. So simply, purely by definition, if you remove a certain set, a large set or a certain set of the investment pool, then you're investing into a narrow pool. So you're going to get much less diversification, much more concentration of assets. So you have that aspect. What else? In terms of Islamic finance, you still have the interest rate risk, because even though you have Islamically friendly, Islamically compliant structures, there is an interest rate risk in everything, be it property, be it trade finance, be it whatever. Then in terms of commodity risk, you've got to look at the structure. Is the commodity transaction you're doing really genuinely a commodity trade transaction, or is it fully repackaged, fully circular, and there's no commodity risk? If there is an element of commodity risk in there, then it's not fully circular, and you've got to look at the commodity risk. Is that real or not? One risk in conventional finance, one major risk in conventional finance is interest rate risk. Now, interest is not permitted in Islamic finance. Interest is definitely riba and definitely haram. But one can't avoid the fact that interest rate risk, even though interest is not permitted, interest rate risk still applies to Islamic finance, because the interest rates affect the rate of return on everything. They affect the value of property, they affect the value of trade finance, and they feed through to the market, and they will also affect the rate of return risk in conventional finance, and they affect the balance sheets of Islamic banks. So even though interest is prohibited in Islamic finance, one cannot avoid interest rate risk, which feeds through everything, including the rate of return on Islamically compliant products. To summarize, the risks on Islamic finance are really no different from the risks in conventional finance, but there are some particular issues. There's the issue of moral hazard. You've got to be able to pass on losses if you have a profit and loss sharing scheme, and then there's risk of religious risk, a halal haram risk. Will the product be deemed to be haram 6 months or a year down? And then what happens to your product? You cannot reissue, or if you're holding the product, the value in terms of an Islamically compliant investment goes, and you've got to either sell them quickly, or you certainly see a fall in the value. So that's essentially Islamic versus conventional risk, essentially the same, but there are particular issues where they can be different, primarily due to changes in perception of the Islamic product.